If we get going in this next leg, and I think we will, stock market being a key factor, that $50 is just it's a paper target. You know, everybody's looking at it, but you'll blow it out. You'll go well up in between there and 100 or something. You know, I've got some reasons to think the mid-60s before you even stop for a pause. Now, we've been viewing the action in the stock market as topping action for the last couple quarters, actually. And if you look at the S&P, just for example, right now you're trading, probably about where you were in the peak in mid-July. Okay? So you've gone nowhere. Okay, yeah, you've been up, you've been down, but it's really not the dynamics. If you even just stand back and look at price since the 2009 low, in the pullback into 2022, and then since 2022, it's really getting sluggish up here. And the S&P made a new high in order to get those headlines. You know, they love it. All-time new high, Trump's elected, all this stuff. NASDAQ 100 did not. It missed it by a little bit, no big deal. But the spread relationship, which a technical feature we measure, between the S&P and the NASDAQ 100, NASDAQ 100 being the leader index, leader meaning it was the most percent gainer from 2009 to the present, and it will be the most percent loser once you go into a bear trend. This was the case back at .com, for example. You know, internet was going to take us off the planet. It changed the world. And in fact, it did, but the NASDAQ 100 dropped 82% between 2000 and 2002. It was the leader then, it's the leader now. The technicals we see on NASDAQ are such that the recent price lows we've seen a couple weeks back, which were just below 21,000 in the 20,700, 20,800 zone. I'm talking NASDAQ 100 now. You don't want to go back there again and close a week there. Not because of price, but because we run quarterly momentum of the NASDAQ 100 and the S&P. S&P's already fractured itself prior to the recent rally. But the NASDAQ has yet to break our key structure. And when it does, we think there will, in fact, be a sharp layered decline. It doesn't have to be a crash. Could be, but, it doesn't have to be. Instead, I think you probably should expect something more like the bear market. I think that's what it will begin. Will commence in double-digit % slabs of decline. You get to those numbers that I just defined, you could drop another 5 in a second, because there's no more support for another 5%. When you blow that level, you could really start to go down in a more panicked way. And it's the panic factor that is not in the market. Most of the people who've been bearish based on, the norms of excess that people look at, the old textbook things, fundamental type things, they've been skeptical for some time. And yet it's not gone down. So they're really frustrated. And most of them are just now, we need a correction. They've given up on the bear market idea. We have not. Okay. We think we have the biggest stock market bubble in U.S. history. You go back and look 1923 to 29, look at the age of the bull trend, percentage dynamics on the upside. Look at the .com move, mid-90s to 2000, % gain over what span of time. And then the move from the 2002 low to the 2007 high, the real estate mortgage crisis bubble. Each of those was far less long-term in terms of years accumulated, and second, in terms of upside dimension. And you say, I guess the economy's been good. Well, instead, go to the St. Louis Fed site and punch up an M2 chart, money supply. And look at the rate of growth over the last 15 years compared to any other 15 years. And then especially look at the Fed funds rate chart, the rate that the Fed controls, the very short end of the market. Never have we seen, the last 10 or 15 years, free money for 10 or 15 years, effectively. There was an uptick there prior to 2000, and then they yanked it back down when COVID occurred, kept it at zero for a while, then took it back up again. Now they're cutting it again. But of the last 15 years, 10 of those have been effectively zero rates. And even with the rate rise we saw that ended a year ago, they paused and now they're starting to retreat. Even that peak was very low historically when you go back 50 years and look at interest rate levels. So there's a good causative factor of why is this particular asset category, this paper asset category, the stock market, so boosted over such a period of time. Well, it had, a drug injection in its arm, okay? Free money. And that's one of the key factors that anybody integrates into their thought process when they're making an investment commitment. It's been our pivotal point in our reports because we look at all four major asset categories. We don't just look at gold and silver. You can't do that. They're impacted by other markets that impact central banks, that impact the growth in money, et cetera, et cetera. So they're all tied together. And when you break the stock market, I think that's when you will start to see the verticality, which we've already seen some pretty good stuff. If you stand back and look at it, ignore the zigzags that always occur. Gold, for example, last year, close of 24, close of 23 to close of 24, was up more than the S&P. Silver matched basically the S&P. So, nobody cheered that. It wasn't on the major financial channels. It was all stock market. So they've ignored that reality. And I think you'll start to see a further separation where gold continues up and its related markets, and the other paper assets start to bleed. And when they bleed, that money goes somewhere. Now, as far as silver versus gold, it's dirt cheap off the page. We know that, historically speaking. Now, it's either fundamentally lost any rationale for being, okay, which we know isn't true, or it's an error. Silver's just priced too low. These things happen in markets. Markets get priced too high and they pay the dues. Markets get priced too low for so long and they go up and you hardly need an excuse. It's just that they were underpriced for too long. And I think silver's in that category. Technically, we can measure the spread relation between silver and gold. And I've got some numbers that we're monitoring that wouldn't take much on the upside over the next few weeks even, where silver gains a bit to gold, and it will break out on these technical metrics of the measuring the relationship between the two. And I would bet that would probably coincide with gold one being back to and through its highs, 2,800, but silver also back up to its highs, 35. At that point in time, silver's still cheap to gold. I mean, like you said, gold's way over its 2011 high and so forth. Silver's not above its dual highs at 50. I think it's the next move that's likely to blow that stuff out. And I don't think 50 is a target, by the way. If we get going in this next leg, and I think we will, stock market being a key factor, that $50 is just it's a paper target. Everybody's looking at it, but you'll blow it out. You'll go well up in between there and 100 or something. I've got some reasons to think the mid-60s before you even stop for a pause. But the key right now is that what happens in this current situation, break that stock market, break the Sensex, break the Nikkei, and you'll have central banks go berserk, and we know what wins when they go berserk. I'm personally bought 4 major silver miners recently, and it is disclosed in all of our reports in the back. I own this and that, I'm emphasizing right now not gold and silver, but silver over gold, but also the miners. The miners are dirt cheap compared to gold. Historically speaking, go back 20, 30 years, you can look at the relationship between them. And also the gold miners as a subsector of the stock market are off the page cheap compared to the S&P. But that sort of hides the truth. The top chart shows the XAU index, which is the Philadelphia Gold and Silver Miners Index. It's been around a long time, since the 1980s, so this is why we use it. It's got a lot of history. And when you look at that spread chart versus gold, you'll see that the spread relationship between XAU and gold, what we do to measure that is we measure the price of XAU divided into gold expressed as a percent. And so back in the 1980s through 2008 or so, XAU index was trading at 25, 30%, even got up to 38% of the price of gold. XAU versus 1 ounce of gold. And the lows were around 17, 18%. Meaning whenever you get a dip and the price of XAU dropped to about 18%, it would find support. And so in that top chart, you'll see there was this range at a high level. But in 2008-9, just prior to the onset of the gold bear market, the spread broke, where the miners started to break in relation to gold. And their performance collapsed down to when? To the December 2015 low. So the spread, in other words, the lessening performance of the miners versus gold, dropped until gold and silver and miners actually made their price low, which was December 2015. But if you look at that spread chart, you'll see that over the last 9 years, since late 2015, the spread has gone sideways. Yes, at a very depressed level, but it hasn't gone down anymore. Now, you say, well, that's a dog. Well, actually not. Right now, the spread is a little bit higher than it was at the close of December 2015. Now, what does that say? It says that miners have been a par performer, sideways performer to gold, meaning they've gone up just as much as gold has during the last 9 years. You tell the average investor that and he'd chuckle, but it's a fact, measurable fact. The miners have matched the gains in gold. The question is now, when do they break out? And you can see I've plotted a 3-point downtrend line on that spread, but there's also this basing range of 9 years. I think we're going to break out of this range, and we measure various things to determine when that's occurring, not just this spread chart. But when you break out, look at that line overhead on the spread. The old lows at about 18% over. That's resistance level now. It was support for years and years. If you break out now from where we are, you're likely to find resistance up there. But let me tell you, we're trading just above 5% now. That's a triple and more in the spread relationship. What that says is if that spread breaks out and you even just go to the bottom end of the prior multi-decade range, that means gold miners will have tripled the performance of gold in getting there. Okay? So at that point in time, if we see that kind of breakout, I'm of the view that in this phase of the gold bull market, the miners will wake up and no longer just par perform to gold, but vastly outperform it. And just go back to an old low. It's hardly asking for a home run even. Anyway, there's another relationship to this, a chart below it, which shows similar type behavior of the XAU index, the gold silver miners, versus the S&P 500. And as you can see on that chart, if you go back into the mid-1980s, you'll see it was up at 50%. I mean, the XAU was trading half the price of the S&P at that time. Wow, okay. And it was, it declined in a staircase manner, but up and through till 2006, it was still above 20%. Okay, so we're now down at about 2% or so. Price of XAU versus the S&P. Now, it also has a multi-year range at the bottom there, that little deadpan action that you see on the spread. Same thing occurred there, a little better. XAU is actually up more than the S&P over the last 9 years. Hard to believe. But that spread low that we made in late 2015 is actually below the current level. Meaning the current spread relationship's higher than that. Meaning it's actually gained some versus the S&P. So in net price, if you measure where was XAU in December 2015 and now, S&P December 2015 and now, XAU has beat it. Tell somebody at a cocktail party that and they'll laugh their head off, okay? It's a fact. The issue now is to break out of these bases. And I'm suspecting that when you break out of the gold base, XAU versus gold, you'll simultaneously be breaking out of the S&P versus XAU spread base. And if you look at that line that I've drawn on the XAU versus S&P chart, it's up around 17, 18%, where the highs there was a low back in 93, and then the highs that we reached back at the 2011 bull market peak in gold. XAU then was up around 18% of the price of the S&P. If you go from where you are now, 2+%, up to about 18%, you do the math on the multiples there, okay? It's enormous what the gold miners could do in relation to the S&P. And they've certainly earned the right to do it because that's a 9-year wide base. They've proven we're not going any lower in relative value to the S&P. The only issue is when are we going to turn back up? And that's why I think that you got to watch these relationships, because if these break out, it will coincide with a net price acceleration in the monetary metals and also a downward price in the S&P, but a resurgence in the miners where, again, money flows out of a broken asset category into tiny subsector of the stock market, where investors say, what's been working? What's not going down? And the gold miners are it, gold and silver miners.